Welcome back to the deep dive. Our mission here is pretty simple, really. We take this huge pile of sources, articles, research papers, all the data, and we pull out the crucial insights for you. It's the shortcut to being completely up to speed on the topics that really matter. Today, we are diving deep into one of the most stubborn economic mysteries of the post-pandemic era, the U.S. economy and what's being called the consumer confidence paradox. We're talking about that huge disconnect where, for the last few years, a lot of people have felt really pessimistic about the future, yet the hard economic numbers, especially spending, just kept on going. The old playbook says bad feelings should equal a recession, but, well, it hasn't happened.
And to really crack this, we're leaning on some incredibly detailed analyses from the Federal Reserve banks, specifically Chicago and New York, plus commentary from places like Deloitte. And before we jump in, a quick note on where this kind of economic intelligence comes from. Banksandbankers.com. I mean, our whole mission is to decode these complex banking and economic trends to provide smart, insightful discussions for professionals, sure, but also for anyone who's just genuinely curious and wants to know what's actually driving the economy, not just the headlines.
That distinction is everything, isn't it? The headlines versus reality. And you have to start with this one staggering data point from the sources. So we all know confidence fell during the early pandemic chaos, right? But look what happened later. In June 2022, the University of Michigan's Index of Consumer Sentiment, the ICS, it plunged to 50. That is the lowest level recorded since they started these surveys back in 1978. I mean, that's a number that belongs next to the crushing 1980 recession.
Oh, absolutely. That kind of number is, it's an economic emergency siren. If you're an economist who relies on those historical correlations, a reading of 50 just screams that households are about to lock everything down, that massive spending cuts are coming, and a really severe recession is pretty much unavoidable.
That is not what happened. And here's the punchline to the whole paradox. Despite this historically awful sentiment, the U.S. economy kept growing steadily. And consumer spending, which is the lifeblood of our GDP, it ended up 9.8% higher than it was before the pandemic even hit. So people were reporting record levels of economic misery, but their wallets were wide open.
And that's our mission for this deep dive. Historically, those two things, how people feel and how they spend, they moved in lockstep. When sentiment went down, spending went down, and a recession usually followed. Since the pandemic, that relationship has just completely fractured. So we really need to get into the sources to understand why these confidence numbers have become so unreliable.
Okay, let's unpack this. We've got the paradox laid out. To understand why it exists, we have to start with the data itself. Our sources focus on two main confidence indices. What are they, and how did they used to work before all this?
So we're looking at the University of Michigan's Index of Consumer Sentiment, the ICS, and the Conference Board's Consumer Confidence Index, or CCI. And they were, or at least they were supposed to be, key economic bellwethers. Think of them like forward indicators. Historically, they would tend to decline before a recession officially kicked off, like leading up to the 2007-2009 crisis. And they'd stay pretty high during strong growth periods. They were the early warning system.
Right, and the sources show that sentiment did bounce back a little after that very brief 2020 recession, but then it just lost steam. Fast. The real puzzle got going in 2021 and 2022, especially for the ICS, which just fell off a cliff, way faster and lower than anyone expected. For any economist looking at that, it had to look like a guaranteed recession was coming.
That's exactly why it became such a puzzle. Imagine you're a forecaster. Your most reliable tool, the ICS, is sitting at 1980s crisis levels, but at the same time, jobs are everywhere and GDP is growing. It forced a huge reevaluation of the index itself. Why was this happening?
Okay, so if the two indices and the actual economy are out of sync, let's start with the differences between the indices themselves. The research suggests the gap between the ICS and the slightly more positive CCI is partly because of how they're built. What are the key differences there?
It's a huge distinction, and it all comes down to the questions they ask. The Michigan survey, the ICS, it specifically asks about your plans to buy large household durable goods.
Things like refrigerators, cars.
Exactly. Major appliances.
Yep.
And as inflation just surged in 2021 and 2022, the prices for those big-ticket items went through the roof.
So the rising cost of a new washing machine directly tanked the ICS reading. It was measuring inflation anxiety more than anything else.
That's a great way to put it. Consumers felt that inflation hit directly, and the ICS's methodology made it super vulnerable to that shock. Now, you contrast that with the Conference Board CCI. Its survey design is much more focused on the labor market. And at the exact same time inflation was spiking, we had this incredibly strong job market.
So because people felt secure in their jobs, the CCI was able to kind of shrug off some of that inflation panic and stay a bit more optimistic.
Precisely. The Chicago Fed economists pointed this out directly. They said the inability of the Michigan index to account for the powerful positive effect of a strong labor market is a central reason it just completely disconnected from actual growth.
And this wasn't totally new,
Yeah.
right? The sources mentioned a similar, smaller gap happening even before the pandemic.
Yes, between 2016 and 2019, we saw a smaller version of this. Inflation was creeping up, but unemployment kept going down, and that just reinforces the point. The health of the job market matters a lot more to the CCI, which gives it this resilience that the ICS, with its focus on inflation-sensitive goods, just doesn't have.
Okay, so methodology explains the gap between the two indices. But that still leaves the bigger question. Why were they both so much lower than pre-pandemic levels? What explains that general, persistent pessimism, even with a great job market? This is where the behavioral stuff comes in. It's fascinating.
The sources really highlight two big behavioral drivers. First one is recency bias. I mean, you have to remember the sheer scale of the shock we all went through. The pandemic wasn't just a recession, it was a once-in-a-century health crisis. You had mass death, lockdowns, just unprecedented uncertainty. So even when the economic numbers got better, the memory of that trauma made worse by new variants, it just continued to weigh on people's minds.
That makes so much sense. It's hard to be optimistic about buying a new car when you're still, emotionally processing everything that just happened. The recent past just overrides the current data.
Exactly. That's recency bias. And then the second factor, which makes it all worse, is information overload. Thanks to the internet, social media, the world is just instantly connected. Bad news and a lot of fake news travels faster than ever before, and that can really distort your perception of things, even when the economy is objectively doing well.
And the sources really double down on just how negative the information environment has become.
They do. There's a study from Brookings that found reporting on the economy has become steadily more negative since around 2018, and that trend just accelerated like crazy in the last few years. So we're living in this ecosystem where any little piece of bad news gets amplified and creates this disproportionate sense of negativity, no matter what's actually happening with spending or jobs.
Okay, now let's pivot to what might be the most controversial factor of all. Politics. The sources suggest that your political party plays a huge role in your reported sentiment, but maybe it's all just noise, not a real signal.
This comes from a really amazing analysis by the New York Fed after the 2016 election. What they saw was immediately after the election, Republicans suddenly became way more optimistic than Democrats about, well, everything: personal finances, job prospects, government debt, stock prices. It was a textbook case of political polarization bleeding into economic expectations.
But the key to the paradox, the really crucial disconnect, is what happened next. That huge partisan swing in what people said they felt. It did not translate into a change in how they actually behaved. Democrats and Republicans didn't suddenly start spending their money in radically different ways.
This is the moment we realize survey answers aren't always true beliefs. The hypothesis the researchers came up with is really powerful. They say consumers' reported expectations have two parts. First, there are your true beliefs, the rational calculations you use to make real decisions about spending and saving. And second, there's just noise.
Can you give us an analogy for that? How does that work in practice?
Sure. Think of it like this. On the survey, you might tell the researcher you feel anxious about the country's direction, so you plan to save more. That's the noisy, emotional, maybe political part. But then your bank statement shows you just bought a new dishwasher and booked a vacation. That spending reflects your true belief, your realistic assessment of your own job security and income. The research suggests election outcomes mostly affect that noisy part of the survey, which is why actual spending behavior didn't split along party lines.
So, if consumer sentiment, our traditional go-to indicator, is noisy, unreliable, and biased, what should we actually be looking at to predict a recession? What are the true predictors?
We have to move away from subjective mood and towards objective financial indicators. The gold standard for recession prediction, which still has the highest predictive power, is the Treasury term spread. That's just the difference between the 10-year and the 3-month Treasury yield. It's been incredibly reliable, especially for looking out a year or more.
But the sources also found something really important about its short-term power, right? Which is critical for policy decisions.
Yes. For short-term predictions, say 3 to 6 months out, just looking at today's term spread is a little better than a coin flip. The huge finding is that if you add the 6-month lagged observation, so looking at how the curve has changed over the last 6 months, you dramatically improve its accuracy.
Can you quantify that for us? How much better does it get?
I can. Using the term spread alone to predict a recession in the next 3 to 6 months is basically a random guess. But when you add in that 6 month change, the forecast accuracy goes from random chance to being right about 3 out of every 4 times. The dynamics of the curve, the speed and direction it's moving, that's the real signal.
That is a massive improvement. But the research also uncovered a surprising and really powerful new indicator for longer-term forecasts. What is it?
It's margin debit at NYSE broker-dealers. It's basically a solid measure of leverage, how much money is being borrowed inside the financial system. And this variable massively improved recession forecasting, consistently ranking in the top 3 for predictions 18 and 24 months out.
That seems counterintuitive. Why would leverage on Wall Street be a better predictor of a Main Street recession than how people feel about their own jobs?
Because it gets at the singular importance of the health of financial institutions, their balance sheets. When broker-dealers and banks are carrying way too much risk on borrowed money, they are incredibly vulnerable to shocks. If they get hit, they freeze up lending, and that freeze spreads the whole economy fast. It doesn't matter how confident you feel if you can't get a loan. Margin debt signals that systemic risk long before it shows up in the unemployment numbers.
So, okay, here's the final summary then. To really gauge recession risk today, we need to ignore the noise from polarized, biased consumer sentiment. Instead, businesses, banks, everyone should be focused on the dynamics of the term spread, especially those short-term changes, and these solid measures of financial leverage, like broker-dealer margin debits. Those are the truly reliable guides.
And the final takeaway for you is that this whole consumer confidence paradox isn't really about consumers being wrong or irrational. It's about these noisy behavioral factors: politics, media, emotion drowning out the true economic signal. Your mood might be pessimistic, but your actual spending power, which is backed by a strong job market, tells a much different and, frankly, a more reliable story.
That really changes how we should read the economic news, and it leaves me with this thought. Considering the predictive power of broker-dealer margin debits, what other hidden measures of financial sector risk might be signaling strength or weakness right now? Signals that we're completely missing by only looking at the traditional data. That's definitely something to think about. To stay up to date with the latest news, data, and fascinating insights in the banking and economic world, make sure to visit banksandbankers.com. That is all for this deep dive. We'll see you next time.